Well, Joshua Stega here from ETFadviser.com.au. Today I'm going to do something different for the weekly update because we've had a special circumstance. We've had a correction that commenced in the US time zone, US afternoon for their trading time zone. So, you know, in terms of the usual structure, how I do the weekly email, all our data is going to be out because the ASX was closed, obviously, when the correction started. So certainly it's going to be an interesting Monday for investors. But what I've done is a special correction report, and that's available to subscribers and also non-subscribers or non-paying subscribers who are following me on Substack. So certainly look at signing up and you'll get access to this right now. And yeah, it's basically just a playbook for how we're going to be watching the market this week and how we're going to play things from here. So basically what's happened is the trade war's escalated again. So obviously we had a massive correction at the start of the year regarding the trade war. So China's Trump's basically wanting to put additional tariffs on China because of some of the actions they've been taking with rare earths and whatnot. So that's led to this tweet out at in the afternoon in the US has led to a Friday afternoon global sell-off. And you can see in the US, you know, markets were off. So Dow was off 1.9%, Nasdaq was off 3.5%. The volatility spiked 30%. So the VIX index. And then in terms of the futures markets, this is what's basically happened. So you can see obviously Hong Kong, Taiwan, China bared the brunt of the correction, and also crypto as well, which I'll touch base on that. But really, this is early days. You know, our market was closed. We'll see what happens on Monday when we open up. So it's going to be really interesting. And therefore, we've got a bit of a playbook, and I just want to run through that. So, you know, it wasn't, you know, we've certainly been expecting a market sell-off, and you can see, you know, we've been talking about it for weeks, and actually look at, this was last week's weekly review. And you can see, I mean, the picture kind of tells a story, and that was kind of a bit of almost told the future there where, yeah, the market's run so hard that, you know, eventually it has to correct. And we've been talking about that, you know, be mindful of any signs of weakness. You know, we've been talking about that for weeks. It has been really strong. So the bulls have been in charge, but watch for any signs of weakness, which could come quickly. Also, this, you know, just last week, markets are strong, many are extended, and that's the problem. The markets were very extended. Don't get too overconfident. Pullbacks can come quickly, and that's exactly what's happened here. So now it's about what we do from here. In particular, what was quite telling is the volatility. So this is a 20-year data time frame to the end of last year, and it shows the volatility of the S&P 500, you know, month to month. So it generally starts off quite low, no volatility until, you know, February, March, really high volatility, April, settles back in for the middle of the year, spikes again before the end of the year, and then, you know, tapers off into the end of the year. So these, you know, it's played out this year that the March, April had been the most volatile time, and now right on cue, it looks like, you know, October is going to be the most volatile time as well. So I don't know, it just tends to happen. This is 20 years in data, and it's funny how things seem to play out. So just in terms of, that's kind of what we're expecting. Markets were very extended, and then just waiting for an excuse to sell off. And, you know, an escalation in the tariff war is certainly one of those reasons for a sell-off. So, you know, thus far, we don't know whether this is going to be a more significant correction or not. Is it just a crack or the start of a multi-month market correction? I think probably not, but, you know, it's very early days, though, you know, governments are spending and cutting rates, central banks are cutting rates, and the themes that are driving the markets remain AI, robotics, energy, critical minerals, automation. So that's still playing out. So we'll see. Obviously, it's too early to tell, but we'll see whether this is actually a buying opportunity or not. And the way to do that was, we're going to be watching those charts, because that tells us what investors are actually doing with their money, not what they're saying. So, you know, let's cover off on where we're at. So here's the volatility index, the VIX, and we were, you know, So there's the spike back in the tariff correction, April, March, April, and then, really complacent, got really down to kind of lows, really tight action here. Obviously, this coincides with when the market's the strongest, and now, right on cue, it's spiked again. So where does it go? Does it go back up to here, or does it have to go back up to here or here? So, it certainly could continue to be volatile, so we have to be aware of that. And as I said, that's within that seasonal pattern, so not out of the ordinary. Was expected. We'll see how that plays out. But in general, it looks like the entire October is going to be volatile. So, no need to rush at the moment. We're just going to wait and watch. Take it day by day, week by week. The chart and the market action is going to tell the story. So we've been talking about for subscribers for weeks. And this is going back to 31st of August, actually. And what we were watching on the S&P 500 was that 20-day moving average. And you can see, there's your tariff correction. There's a 20-day moving average, held here, held here, held here, held here, held here. Never spent 2 days below. And then for the Nasdaq, what we've been watching is the 50-day moving average. Obviously, it cracked there back, when we had the tariff correction, and then it's held here, held here, held here. And that was back in August. So now, look where we're at. S&P 500 has now cracked through that 20-day moving average. So that's that moving average in purple. It never kind of spent 2 days under it. It's currently cracked through it. Unlikely that it's going to recover back above it. So that's a change of character, really significant. It's on that 50-day moving average now. So what does that mean? I mean, does it have to come back and retest here before it can go again? I mean, that's around 10% lower if it has to come back and retest this previous, drop into this previous base here. So that's, something to keep in mind. I mean, it could hold this and then, reset, or it might need to go a lot lower. And certainly what's needed is time, and that lines up with that volatility. It's probably going to be volatile for the entire October into November, so another month at least, month to 6 weeks of volatility is going to be likely. So here's on the S&P on the Nasdaq, and you can see there's your tariff correction, and then obviously it got above, the moving averages here, had a good trend, held the 20-day, 20-day. Now it was the 50-day. So never spent kind of 2 days, 3 days below, or 2 days below the 50-day. Now it's just broken through the 50-day, big volume. Once again, does that have to come back and retest the top of this previous base, which is once again about another 10% lower? Does it hold here? We don't know yet, but certainly this is another big change of character. That's something we've been watching. So all bets are off. Watch the market and be cautious. The Russell, so this is the small caps in the US, and you can see very clearly this has been a V-shaped rally. They're unlikely to work just because you need time to there's often sellers at these previous highs, and you need time to kind of shake them out. And you can kind of see, very V-shape here on the daily. Couldn't get through into new highs. Now it's shaking out. It has held the 50-day moving average back here. We'll see how it reacts. It's not on the 50-day yet, but probably likely to be this week. Is this what needs to happen as well? 10% correction, then set up for a year-end rally. I mean, anyone's guess at the moment, but potentially that would make the chart look a whole lot better and just give you a bit more time to set up correctly for a proper move. So V-shaped rallies like this rarely work just because it's too up straight up from the base without shaking out the sellers, and it just needs a bit more time to set up properly. So that's where we are with the Russell. In terms of the industries in the US, the only thing that was really green was gold miners, slightly positive, and all the rest, the worst semiconductors. Oil's been really smashed, back to new lows. A bit of clean energy. So energy, solar, they had been running, so a bit of profit taking there as well. So that's going to be quite interesting. Now, obviously, the big markets for us on Monday are going to be the Asian markets. So the ASX is going to open first. We might just cover off on that first. So just in terms of the Aussie market, this is it's going to be interesting to see how it plays out. It had been holding that 50-day moving average here as well, 50-day, 50-day, 50-day. It'd be on the 50-day now. Does it also need to come back, retest this base, which is around 5%, before it can set up for that Christmas rally? But certainly, if you just even look at that squiggle, that's going to take out, certainly the rest of the month and into November, just in terms of timeframes for that to play out. So yeah, that's obviously what we'll be watching. Once it breaks that, it's a definite change of character and kind of everything's off the table. So we've got to be a little bit cautious. In terms of seasonality for the Aussie market, the ASX 200, you can see, more volatile. So it's kind of played out with the tariff correction, more volatile March, April, May, generally, pretty steady here, and then, tends to have a strong finish into the end of the year, but can be volatile through this October-November period. So, that's also playing out as well, which is interesting. So that's the Aussie market. That's going to open up first. We're also going to have Japan open up pretty shortly after in terms of the futures. So obviously this had come out of a really nice base. But look at that. I mean, that's pretty extended if that's your base. Kind of been holding that 20-day moving average, now on the 20-day moving average. So what happens here? Does it have to go to the 50-day? Does it need to come back to retest this base like the rest of the markets and do that with a bit more time? So that's going to be interesting. We'll see how that plays out. That'll be just after the Aussie market opens. Obviously, who's borne the brunt of these corrections, obviously being China and Hong Kong. So this is the Chinese index. This is where they announced stimulus. This is kind of then your tariff correction here. But you can kind of see, it's a big base, and it feels like that, now this correction here will give it that third kind of compression, which would set it up really well. But does that mean now it's a 2026 story, or will it be shorter and be able to go through there? In any event, it looks like it's coming back to test the top of this base as well, and then potentially set up for another year-end rally, because that's what the the Chinese markets tends to do as well. It's generally, a bit slow and steady in the middle of the year, strong at the start, and is usually a strong finisher. So that'll be really interesting to watch as well. And once again, that's 20 years of data to the end of last year. So, in terms of how that would play out, I mean, that looks quite good in terms of a chart, and the way a base would potentially pay out. Is it cup with handle, or is it like those three compressions? We'll see how that plays out, but we want to see and watch. What's been interesting for China is the Chinese market's basically been on holidays all week. So they had the National Day of the People's Republic of China, which is pretty much a holiday all week for Chinese. So yeah, it'd be interesting to see how that plays out. When will they come and buy, or will they be sellers into this market as well? Hong Kong market. So you can see once again on the weekly, this looks like a big cup with handle now. That's really quite constructive. Obviously, we've been watching it move through these different levels. It's now come in and already testing the top of this previous base. So we'll see, does it find support here, or does it have to go lower? It will certainly be interesting. It's come off the most in terms of global markets. So we'll see how that plays out. That's going to be quite interesting. And but as a structure, that's probably not too bad. Big cup with handle, or is it then going to need, or is it 2026 story? We don't know, but there were the previous kind of points of resistance, and it's kind of working through. There's that kind of time frame, which is kind of a couple of months here. Does it have to put in a couple of months here as well to get out of this big base? That's the unknown quantity at the moment, but we'll watch and see how that plays out. What's interesting is ECNS. So this is the iShares MSCI China Small Cap ETF. So we've been talking about this for a long time. So even in our 31st August report, just in terms of this kind of resistance here, our target was the early 40s. So actually what's happened was that, so this is the current view on ECNS, actually hit a high of $40.05, and that kind of coincides with this previous high here, and it needs to put in a bit of work before it can get out and kind of shake out these sellers here and set up before it can go again. So it's run some 73% from these kind of tariff lows. So it's been one of the best performing sectors of the global markets. So correction. It's well within its right to have a correction. Doesn't need to come all the way back here, which I think it'll be about another 12%. Or does it hold here and just need a little bit more time before it can go again? It's one to watch, but interesting, we did pick that, and it just tells the story of these, of the left side of that base, that there's going to be some sellers there, some resistance, and that's exactly what's happened. So obviously we'll see, it'll be kind of Australia, Japan, Hong Kong, China, all opening in the morning on Monday, and we'll see how that plays out. In terms of commodities, bit of a mixed bag. So gold has actually held up pretty well. So it's remained that kind of safe haven. It's been one of the top performers this year. Still that safe haven now. What I probably will say is that I'll be watching gold for when it starts to sell off. That may be a time when people start going back into equities. So it might just hold up here, chop around, and then, it might start to sell off, and we'll see if that money then starts to flow into equities. That's something that I've got in my mind at the moment. So that's going to be one to watch, because there's no doubt gold, very crowded trade, very extended, needs some time, but for the time being, it's going to be a safe haven. Gold stocks did sell off, so it was about 4% there. That was on the ASX actually. So already we started to sell off prior to this. So sometimes the market somehow knew something already was underway. So we'll see how that fares. But once again, really quite extended. It's had a massive run from this base. Kind of 3 touches of that moving average, 1, 2. This is the third push. Needs a correction and a base. So that would be normal, and set it up for the end of the year. So that's where we are with gold, and silver obviously held up really well as well. So that's a safe haven, holding up. Once again, is going to chop around here, and then when that sells off, does that mean money's flowing back into equities? I think that may be the play. When that sells off, say later this month, that might be the sign that a bottom's in for the markets. Just something that I've got in mind at the moment. Copper stocks, so this was the in the US, so they sold off about 5.5%. Once again, that had been one of our key ideas, which we bought coming out of this really nice base. Had a huge run, very extended. There's your kind of one touch, 2 touch, third push, really extended, needs a base, and that's all pretty normal. It's had a huge run, so we'll see how that plays out. Oil, we've been looking at that. Obviously, it's not we're looking at it to put in a bottom, but it's still very much in a downtrend. So oil been the weakest, and it's actually sold off another 5%. So that's been even weaker. But so now in terms of oil, we were watching the oil services stocks. So that was starting to look really interesting. Obviously, we had coal. So this is a coal ETF in the US. That was bottoming out as well, forming this nice base here. Obviously, it's into resistance. Does it need to chop around here for months before it can get out or not? Who knows? But that's kind of held up. But oil services was starting to look interesting here. Obviously, it's still on that weekly chart, still kind of in that downtrend, but it looked like it's popped out on the weekly chart, retesting. So I'll be interested to see how that plays out, because natural gas actually looks pretty interesting here, and it's kind of held up. So obviously it's been in this really long weekly base, just doing nothing. But gas, I think it's going to be a key player in the energy space, and it's surprising that it hasn't run yet. A little bit junky here, just trying to get out. But this is interesting so far that it pushed out. So had a little breakout, retesting, held that 20-day. So I'll be watching quite closely to see if this can build out. So natural gas looks better than oil, but it still feels like energy, generally when the commodities start to run, it's kind of like gold, silver, copper, and obviously we've had critical minerals start to move. And then eventually it'll flow into oil as well. So I think it may be a 2026 story. But natural gas looks interesting. I'll just be watching to see how that plays out and whether there's any key ways to play that with ETFs in Australia. In terms of crypto really bore the brunt of the selling on Friday. This is a 24/7 market, so obviously it's continued trading over the weekend. Bitcoin was down about 13% from the highs, so you can see it was pretty brutal. It certainly ran straight up from the bottom, so that doesn't tend to work. You kind of want it to put in more time before it can kind of make a move, a bit more time before it can make a move, whereas here it's just kind of shot straight up, and that's basically what's happened. It's failed straight away, back into the bottom of this base. So we're still within this weekly base, and we'll see how it chops around yet. I wouldn't be writing it off. It seems to have found some support here at the bottom of the base, which is where you wanted it to get some support. But we'll just see how that plays out from here. So that's Bitcoin. And then if we look at Ethereum, was obviously the one that had been the top performer in terms of the major cryptos, but sold off about 25% from the highs. But once again, it's come back into this kind of base on the daily, and now it looks like, that's the previous highs back in 2021, and that's where it found resistance as well. But is this now a big cup with handle? That's something we'll keep in mind. Certainly wanted to see if it's got that support here and whether it can hold that. But once again, just kind of wasn't the right shape. Needed a bit more time, and certainly needs more time now. So that could be a 2026 story. But that they bore the brunt of the selling, and obviously, as I said, 24/7 market, traded all weekend. So really, quite volatile, but it's found support where expected. So for both of them, whereas all the smaller crypto stocks, I've always been a bigger, one to avoid all those. I think only Bitcoin and Ethereum are investment grade. So in terms of portfolio tactics, obviously we've got an income portfolio and we've got a best ideas portfolio. So the key is, this is how we're going to play it. We're going to wait for the open. ETFs don't tend to trade properly on the ASX until after 10:20. So don't be rushing in with open orders before the market opens. Obviously we'll watch, and so this is kind of the game plan. Adjust your position size, down to where you're comfortable sleeping at night, because it is going to be a volatile month. Protect profits, don't let profits turn to losses. Cash up progressively. Just, don't be afraid to take a little bit, and particularly if liquidity continues to rise, just reduce that exposure. Sell down to the sleep peacefully at night level. Hold cash at the ready as liquidity is your edge during downturns, and don't be in a rush. Let the new positions come to you. We're going to have plenty of time, and it's going to be a really key opportunity. So in terms of the income portfolio, we just started that recently. I'll probably be looking to raise 20 to 25% cash pretty quickly, just because it buys you optionality. We'll see how that plays out. And if volatility continues to increase, if the markets sell off more, obviously the cash level will go up. So, if the markets continue to break key levels and look weak, I don't have any problems going to 100% cash, because I'll certainly be ready to get back in when the time's right. So that's something to keep in mind. In terms of best ideas portfolio, we had been handily outperforming the market, been overweight China and Asia, which had been kind of one of the strongest sectors globally. But I'll be pretty quick to raise cash here as well. So in terms of how that's going to play out in terms of our holding, we can kind of see what happened with some of those ETFs in Australia. Even though our market's closed, there are some comparative ETFs in the US. So I'm kind of expecting Asia to be down about 7% on open. So, we're currently up 27. So that'll bring us down to up about 20% on that holding. But this is K Web, which sold off, back to kind of the top of this base. So Not a direct comparison to Asia, but yeah, that'll give us a feel for what's likely to happen just in terms of the holdings. Atom, which is a nuclear energy, that actually didn't sell off much at all in the US, was down about 3%. So that's still a nice profit. Clean energy didn't sell off too much in the US, off about this ICLN is off about 2.5%. Still near highs. I'll watch that. I'll probably hold these. So I'm probably more likely to sell Asia, hold these for the time being, just give them a bit more time. But certainly if they start selling off more and more, yeah, I'll just continue to progressively increase the cash. We've got CNU and Dragon in the portfolio. They should be down about 10%. But as you can see, we're still, in pretty handy profit. I mean, it might wipe out the profit in CNU, so I'll be quick to sell that. But Dragon, we're quite a ways up on that, so it won't wipe out our profit. So maybe able to hold that a little bit longer. QRE, expect that to probably wipe out the open profit on that at the moment. Should be off about 3 to 5% based on what we saw in the US. And we're only up about 3% on that's a relatively new position, so I'll probably be quick to go to cash on that as well. In terms of XMET, we've got DMAT is a bit of an indicator in the US. It's down about 6%. So we'll see how that plays out, but that won't wipe out all our profit, just part of our profit. So I'll just play that out. If the portfolio is about 123 at the moment, maybe I'll go to 100 invested and 20 cash, or just depends. We'll see how the market plays out. Obviously, for subscribers, I'll be outlining exactly what the playbook is there. So for the week ahead, I'm going to provide regular updates to paying subscribers as we get more data. Keys, I won't be rushing in to buy the lows. No point. I want to buy, good solid bases that are setting up and trending. And the best thing about a correction is you can really see where the strength is. So when everything else is selling off, the things that are holding up the best, almost like those beach balls that you put underwater and, they just come straight back up. So we're kind of looking for tennis balls that are going to bounce here. We're not looking for eggs that just go splat. We want things will sell off, but the things that start moving higher first is where we want to be. And, we want to see them coming out of these nice bases as well. So that's pretty much the playbook. I think it's going to be a really important time. This is where we earn our money as investors, and just in terms of the universe, really exciting what we've got in the ETF space in Australia and how we're going to play this all. So I've actually got a market correction offer. If you've been waiting on the sidelines, I know a lot of you have. Obviously, the market's kind of caught everyone off guard in terms of its strength. This is now your opportunity to get started in ETFs. You've got a correction. That's going to be the best time to buy. But there's a way to play it. Obviously we're watching those charts. We want to see what people are actually doing, not what they're saying. But what I'm going to offer you is a 20% discount for annual subscriptions, just for this week only, and certainly would welcome you to join ETFadviser, because I think this is a really key time for markets. We know how well the tariff correction was in terms of returns at the start of the year. Really, really strong markets. A lot of people miss this. How's it going to play out here? Who knows? We'll be watching, but is this still within the realms of, say, a tech boom with AI and everything that's happening, interest rates getting cut? Who knows? But it feels like there's going to be a lot of opportunities. So certainly welcome you to join, take advantage of that offer. And paying subscribers, look out this week. As we get clear data, I'll be giving you updates, and there won't be any rush to buy, but we'll certainly be building a shopping list and be ready when the time's right. And that's probably going to be, it's going to be a matter of weeks, not days, but we'll get ready, and hopefully this will be another really key buying opportunity when the time's right and we've got the playbook and we're ready to take advantage of it.